Income tax 2020. Tax software example, rental property, passive activity limits. Come in, relax with income tax 2020. Here we are in our Lacerte tax software. You don't need the Lacerte tax software to follow along, although I do think they have a 30-day free trial. So if you can get access to a promotional or demo version of the software, it might be a good tool to practice with. We're going to be focusing in on the 1040 and the Schedule E. We're going to be going back and forth from the data input to the forms so we can run different scenarios, the software making it easier to do so. We're going to start off with our scenario as a single filer. Eric Smith, living in Beverly Hills 90210, has the $100,000 of the W-2 wages, the $20,000. That's where we're going to be focusing in on. That's flowing into line 8 from the Schedule E, and then going to Schedule 1, and then going here to line 8. And then we have the $120,000 on the total income, adjusted gross income, $120,000. We then have the $12,400 standard deduction to get us down to the $107,600 of the taxable income. Now we're going to be focusing in on the Schedule E, which is rolling into the Schedule 1, just so you can see the Schedule 1. There's the $20,000 rolling into the Schedule 1 from the Schedule E. Then we go to the Schedule E, and here's going to be our starting point. So we have the rental income. It's going to be for the full year that we have. $50,000 we have on the rents received. And then we're going to just have the $30,000 we just put in a one item in repairs in this case, just to be taking a look at our income and passive activity rules. So note again here, we don't have any real problem because we have a gain or income as opposed to a loss. So we're not going to be subject to the passive activity problems or passive activity rules. Let's see what would happen if we had a loss again. So if I go back on over and say, all right, let's say we have a loss now. So I'm going to bring this up to, let's say this is going to be $60,000. So if we have then the $60,000 and we go back then on over, now we've got a $10,000 loss. Now that loss is subject to the passive activity rules, but we're able to take it if we're actively participating. And so that means that that loss is then flowing into the Form 1040, and there's going to be our loss. We're taking that loss then against the W-2 wages. And we're taking that loss against the W-2 wages in essence because we're assuming we have the active participation. If we were to say we were not actively participating, possibly we have a management company and we're not doing anything, you know, we're not actively participating, or we don't fulfill the requirements to actively participate, then we're not going to get any of that loss here. It's been eliminated due to the passive activity rules. So on the Schedule E, then we see it's not carrying down here. We see the loss up top, but then it's being limited, and it's being limited by the passive activity form, and that's going to be Form 8582. So you can take a look at the instructions for Form 8582 for more items there. So activities with net losses carrying through the $10,000. So let's bring it back on over. So we're going to assume that we do actively participate, and then we're going to increase the loss by, let's increase the loss, say this is 80,000. If we bring that on up to 80,000, then we're going to say now we have a loss of 30,000. So now we have the loss of the 30,000, but we're capped at the loss even though actively participating at the 25,000. That 25,000 being capped here on, once again, the Form 8582, which is basically capping that loss at the 25,000, that then flowing in to the Form 1040. So we have the 25,000 there, bringing us to the 75,000 of the taxable income. So then if we were to say that they actively participate, or that they're a real estate professional, and note, then you want to consider if they're a real estate professional, whether they should be reporting on Schedule E or Schedule C. There, but just note that if they're a real estate professional, then that's when they may have access to the full 30,000. But you also want to see if you should be reporting it on Schedule E or C, and whether or not they should be subject to self-employment tax in the event of having income on that side as well. So just realize but if they're a real estate professional, may not be subject to the loss limitations that would be if they were not. So those are going to be the general rules there. Now, let's bring this back down to a loss of like 10,000. So we're going to bring it back to a loss of 10,000 here. And if we go back on over, there's our loss of 10,000 to the Schedule E. There's our loss of 10,000. And now let's say we had prior year unallowed losses that are going to basically carry over. And let's say we had losses of 10, let's make it 15,000 from the prior year. Now again, this could be a little bit complicated, so if you did have prior year losses, I would put the entire return into, say, the 2019 software and then roll it forward so that the losses carry over properly. But then just to get an idea of what the rollover kind of looks like, then you would say, okay, so now we have the losses carrying in. So here's the 10,000 here, and then the totals bringing us back up to that 25,000 because it's including the losses. So we've got the deductible real estate losses after limitation, if any, from 8582. So form 8582 then. Here we have the 10,000 activities net loss, prior year unallowed losses then at the 15,000, bringing us to that 25. Now if we go higher than that 15 then, for the prior year losses, let's say we had 20,000 from prior years and 10,000 in the current year. So now that's going to bring us up to the 30 then in the current year. 10,000 loss in the current year, and then 25 that rolled over from the prior year to the current year. And that means we can take, even though we had a loss of 10,000 in the current year, up to the 25, and it's going to then cap us at that 25, and then that added 5,000 is the rollover to the following year once again. So if I then go to the Schedule E, we're still capped out at that 25, the added 5, then possibly rolling forward, going back then to the 1040, we've got the 25,000 once again. All right, so I'm going to go back on over. I'm going to remove the prior year rollovers, and once again, you would want to, if you have those rollovers and you have a complex return and a client that you want to hang on to, then I would get the prior year return, enter the prior year return, and then let the system do the rollovers and help you with that process, and then check them. Now let's see if we were a married individual now, or married couple. So we're going to say if they're a married couple, then let's say Eric's getting married to Jane again. Eric got married to Jane, and now we're going to go back to our Schedule E. So now we have Eric and Jane involved, and so we're going to say this is joint. So we'll say this is joint, general, joint, and then I'm going to go back on over, and the Schedule E. So we have that 10,000 once again. Now, what if we brought that 10,000 or that loss up above the 25? Do we get twice that amount? No, we don't get 50,000, you know, if married is what I'm kind of getting at. So 80,000 here. If we go to 80,000, now we have a loss of the 30,000. We're still capped at the 25, even though we had the two individuals married now, which you'd think I would be hoping to get, you know, double the possible loss allowance of the 50,000. No, you're still at the 25. However, the spouse may be able then to help out with the qualifications to make sure that you are an active participant. So you, instead of having to say that you're non-active, did not actively participate, the qualifications for both spouses then can be into consideration as to whether or not there's active participation in order to be able to take the 25,000 in losses in the event that there are losses.